Hello, welcome to our discussion of Main Management's weekly market note. I'm Alex Varner, our head of research here with
James Maxwell, VP of Research.
yeah, let's get into what took place this week. On the kind of trailing performance, as you can see there, the bottom two charts are the weekly returns, and almost everything in the red outside of commodities and consumer staples on the sector side. Year to date, things are mixed. Sectors are, for now more up than down, but I think we're seeing some more negative action today at least.
Yeah. I think one thing to note is that the losers and winners this year to date so far, a lot of those winners have been the losers last year and the year before and vice versa, where tech and common services are laggards
Yeah.
and things like staples, energy, etc. are the winners.
Yeah, you've really seen kind of a leadership reversal
Mhm.
in that, especially from the ones that led the way last year to down this year, infotech being probably the most obvious one, and consumer discretion is getting weighed on by inflation fears, growth scare, that tariffs as consumers are kind of pulling in. Whether or not I think it's more an indication of their feeling
Mhm.
rather than kind of the actual balance sheet
Yep.
or like spending power. But it's definitely the more of the sentiment weighing on things there.
Mhm.
So looking at our recession dashboard, we are discussing potentially some updates in
Mhm.
April. We are going to not commit to anything, but we are discussing
Yep.
some updates for April. So keep an eye out to see if and what changes there on the bottom line. But I think by and large, things are still kind of muddling along.
Yeah. I don't think any changes that we do make are not going to be drastic. Everything turns to red. I think it's
Yeah.
going to be, maybe some things on the margins go from green to blue, but
And this is kind of how our sector rotation strategy works as well, is it's things change kind of one or two sectors at a time,
yep.
rotating in, rotating out. It's not like a hockey line
Yep.
change where all of a sudden you go from 1 month, you're like, oh, the data all dove into fell off the
Let
deep end or
yeah.
whatever you want to put it.
Let's change everything.
Yeah,
Yeah.
exactly. I think the economy generally doesn't work that way. It's kind of like, as we like to say, an oil tanker,
Yep.
slow to turn. So one of the big data points that we got last Friday, it's March 28th, was the core PCE, and that is the Fed's preferred inflation measure. It was up more than expected at 0.37% month over month, and the year over year figure ticked up to 2.79. So rounding 0.4, 2.8. Consumer spending rebounded a bit from its January dip to rise 0.43 month over month, but still that kind of came a little bit short of expectations. Spending is up 5.29% from a year ago. And as you can see in that green line on the right, been holding pretty steady. And those 5.3 number, it's below the kind of the pre-COVID peak, but just barely. And you can see that in 2019, that spending number was accelerating to 5.3, whereas here we've been holding steady around slash above it, which has
Yep.
been good spending relative.
Yeah, on the PCE number, I think that was kind of largely expected to be, roughly high threes. The actual average is zero point 0.3, but there's decimals in between there.
Yeah.
So that reading was, yes, it was hot, but people kind of could impute that from the other PPI data. This number comes out so late in the month that it's kind of like you get all this other inflation data that you can do the math on and kind of figure out what it's going to be
Yeah,
pretty
the
closely.
seeing the CPI number earlier this month from February,
Yep.
they pulled the couple of line items that are common between
Yep.
the CPI and PCE baskets. And even though CPI surprised to the downside, it was cooler than expected. They all the notes that came out said, hey, the couple of line items in here that feed into PCE were
Yep.
hotter. So we expect PCE to be hotter. So this wasn't unexpected in a
Yeah.
way.
Yeah. I think that the one part that I saw that was kind of more unexpected was that spending piece that came in below expectations, especially when, inflation is higher than expected and spending or consumption is lower. It raises those red flags of these words like stagflation.
Yeah.
But that's not our base view. I think it's more just a fear that is out there that there is going to be some slowdown
Yeah.
in consumption as inflation is rising.
And it's hard because you see the spending numbers have been moderating.
Yep.
And I think people kind of forget what life was like, what the numbers were kind
Yep.
of pre-pandemic, and how a lot of the numbers we have now, both on the spending and on the inflation side, are just structurally
Yep.
higher than they were before. And so adjusting to the norm that we had from, call it,
Yeah.
2010 to
Yeah.
2020, people have kind of forgotten how things were then. And then they also add to that, even when they look at those numbers, they forget that there were zero interest rates and inflation was 1.5%.
Mhm.
So a lot of the other numbers kind of taken in context
Mhm.
are a little bit harder to place. And I think markets are having trouble with that.
I think there's a quickness too of seeing one reading and saying, okay, it's this group of stagflation.
Yeah.
Even if you look at the last 12 months or last couple of years, it's like that does not telling you that story,
Yeah.
that same story. It's almost like you're trying to assign something that doesn't have a proper category to fit in.
Yeah, exactly. Yeah, it's been challenging for sure. Also in that PCE release, we got income and saving. Incomes were up big. They were up 0.8% month over month. It was double forecasts. They're up 4.56% year over year. So that continues to outpace inflation,
Yep.
which is real spending power. Now, whether or not people go out and utilize that spending power is a different story.
Yep.
But it is a good thing that incomes continue to outpace inflation. It means real income gains. And then you saw a result is the personal savings kind of ticked up to a 4.6% rate. That means people are putting more money away and not spending it.
Yep.
It's kind of, one or the other. You either save or you spend. And so seeing that savings, we see clearly that the last couple months that consumer spending number has been a little bit weaker and the savings has increased as a result.
Yeah, I think one thing that you flagged that was interesting was that this incomes are rising even though consumption is falling. So you have that savings rate picking up. That I think shows us that the slowdown in spending or the slight slowdown in spending is more due to uncertainty rather than an outright I lost my job, I lost my income, I can't buy anything.
Yeah.
I also want to mention in 2024, you kind of saw this dynamic where people were spending more than they were making on average. So that savings rate you can see in that bottom right kind of steadily drew down over the year. Now you're seeing some of that pick back up where people are like, okay, I have to maybe build back that cash balance, so savings rate.
I want to kind of shore up my nest egg, so to speak, or kind of your cushion in case things do deteriorate a bit more. But it's also worth mentioning, as we said last week, that consumers are still sitting on over $21 trillion in cash, which is an all-time high. And I think that gets discounted a bit too. There is a huge cash pile, and that's not like stocks and bond investments. That is like money market funds and short-term stuff that is very, very liquid. So they have access to draw on that. Looking forward, I guess moving forward, we also got the final reading for Q4 2024 US GDP. And again, this is, in the past, priced in mostly, but it's good to see it revised up to 2.45. I think it got revised up in both sequential estimates, or I guess revisions. Consumer spending would tick down a bit, but still running at 4%. That's the fastest quarter since Q1 of 23. Final sales up solidly. A lot of the chatter you've seen of late around the Q1 2025 figures and the estimates has been more negative, and a lot of that is due to trade. And that's kind of the math within the GDP equation, where imports and exports can skew that headline GDP figure, even though it's 70% consumer spending. So that's important to remember, is a lot of the stuff you saw, even in this Q4 reading, imports and exports were revised relative to the first estimate the most. Imports were down 1.1, exports revised up 0.6. So you see those, you have to say, okay, those do factor into the equation, but spending is still 70% of the economy, and that's really what we're focusing on.
Yeah, especially those kind of real-time GDP indicators, like GDP Now. You get these skewed readings where they're taking in the live data every day,
like 1 day of data, and then it annualizes it.
Yeah, and you're getting the imports exports data, and it skews down, but you don't even have the kind of spending data to offset that, or the corrections to offset what's drawing it down. So you can look at those numbers as a proxy, but they're not the Bible.
Yeah, exactly. It's important to kind of take them with a grain of salt, I suppose. We also got the Q4 core PCE. That was basically unchanged at 2.6. And corporate profits at another all-time high at $3.3 trillion. Yeah, so those are up over 50% from Q3 of 2019. So I think, you would also be a little bit more concerned if you see that green line on the right there. Corporate profits start to dip heading into a recession. And we're not seeing any sign of that. They are just up and to the right. which is at least as far as if you're worried about a recession, that's a good sign that those are continuing on strong. Durable goods orders, that's a monthly data point, but that came out above forecasts, well above forecasts, increased almost 1% month over month. Core capital goods, there's kind of the, every silver lining is a cloud, every cloud is a silver lining. But the kind of cloud around the silver lining here was the core capital goods were down 0.3 month over month. Those are a business spending proxy. So you'd like to see a rebound in March, but we have been seeing some kind of deterioration and slowdown in the business spending surveys. You see that in the regional Fed the regional Fed numbers, the PMIs, just some of the kind of NFIB.
Speaking on that, kind of these surveys, these things, orders, kind of initial, they call it soft data because it's not actually happened. There's not actually spending. It's kind of intentions to spend or intentions to do things.
Or like, how do you think the sales is going to be?
Yeah, it's questions about what do you think? What are you going to do? What do you in the future? A lot of that data has been weak the past month or so. I think traditionally that's seen as a leading indicator. It's fallen apart. That correlation has fallen apart since post-COVID. 2022, you had a lot of the same things where the soft data was very weak and the hard data was fine. So people were looking at the soft data saying, oh, the hard data is going to fall, the hard data is going to fall. And it never really fell. Similar dynamic here where the hard data is fine, the soft data is weak. Will it be the same as 2022? Will it be different? That's less clear. But that's something to watch for sure.
Certainly.
This is orders, it's soft data. It's not actually what's going on in the economy.
They don't go back and hold the guys to what they said they were going to do. They say, so it's worth watching that disconnect that we've kind of seen there, and whether or not that correlation kind of resumes. And then something we were talking about, as you'd want to talk about soft data being in the trough, sentiment has been just super pessimistic. The Conference Board's consumer confidence headline fell to below 93. It's the lowest since January 21. Expectations index, it's forward looking, fell to its lowest level since March of 2013. So it's even below like COVID levels. I mean, it's kind of hard to, to think, you look at this, you look at the economy, you're like, are people as afraid of tariffs as they were of a pandemic? It's kind of hard to reconcile why people are so pessimistic when, as we said, the hard data seems to be holding up okay. And then you saw on the right there, that's University of Michigan. It's at its lowest level since November of 22, which is just after the bear market bottom, and the expectation in current conditions moved lower. So the sentiment numbers are declining, and they're kind of at or below recessionary levels. Which is, I don't want to say alarming, but it's something.
One thing that I will note about kind of sentiment indicators broadly is that they are forward looking, they are leading, and they also have a higher correlation with kind of the equity markets and the stock market. Because the equity market is forward looking as well. Typically, when you see these kind of crashes in sentiment or kind of spikes in uncertainty, that is generally a good indicator for stocks. Maybe
they're
not
kind of a contrarian indicator.
Maybe not on the week to week, but kind of on the forward 12 months. It's like, people are uncertain. There's fear in the streets. There's blood in the streets. You want to go out and be greedy.
And these surveys are, people are responding to these. They pick up the phone, and they are also conveying what they see in the headlines, the media. So when they see markets down, as James just said, they think, oh, that's bad, and then they become bearish, and they respond in a bearish in a bearish way, which drives the sentiment lower. They hear tariffs are coming, inflation's coming, my eggs are still expensive. They don't like that.
It's self-reinforcing as well, where markets respond to the negative sentiment that's due to markets being negative.
Exactly. Yeah. And finally, something also on that point is we've seen, speaking of inflation, but inflation expectations have kind of become almost unmoored in a way, in that, as we saw, the PCE number surprised slightly to the upside. CPI and PPI were cooler than expected. And yet here, in the last 2 months, consumer inflation expectations have shot up and to the right. And you've seen a divergence here too. Michigan and the Conference Board expectations have surged. I think one of those is, it's Michigan's 5-year, I think, is up at its highest level since like the early 90s, which is kind of wild to me. And yet the NY Fed survey of consumer expectations has remained relatively low, around 3.31. I'm not sure what the difference in, they have different methodologies. They have obviously different response pool. So
Yeah.
there's something underlying there that is maybe driving this difference.
One thing that I've read is just the way that people get asked the question,
Hmm.
whether it's what do you think prices are going to do? What do you think inflation is going to do? The general public, the
Yeah.
people that they're asking, might not even understand the difference between like price level and rate of change of
Yeah,
inflation,
that's very true.
or even like the second derivative
Like
of
the
like change.
semantics of the
Yeah,
phrasing. Yeah.
where people are saying inflation's still high. It's like, well, it's at 3%.
Yeah.
It's your prices are still high. Like that might be correct,
Yeah.
but it's the rate of change versus the absolute level is something that is lost on some
Yeah, I think
respondents.
when you hear people confuse decelerating with deflation, and they think, oh, it's cooler than expected, yet if it goes from 4% growth to 2% growth, that's a deceleration, but it
Yep.
is still growing and still rising in price, just at a
Yep.
slower rate. And they conflate that with the price going down.
Going
They
down.
think it went from 4 to
Yep.
2, it should be getting lower, even
Yes.
though it's
Yep.
just going up more slowly. So I think there's a potentially a misunderstanding in the phrasing or how math works sometimes.
Yeah.
But I think that's about it for the market note this week. We got the summary here. This coming week, this is where the quarter rolls over Q1 into Q2. We have a lot of employment data the first week of
Yep.
the month, and we also get that trade balance, which will be kind of more closely watched than usual given the tariff conversations. And then we have Liberation Day, April 2nd. We'll see what happens there. I think a lot of people are.
Does anyone know what's going to happen?
I don't know. I'm not sure, but I think there's one way to find out,
Yep.
and
We'll see.
we'll see what happens on Liberation Day.
Yep.
So I think on that note, we'll leave it there. I hope everybody had a nice weekend, and we will catch up with you next week.
All right. Thank you.